All right, due to some technical difficulties, we had to start a couple minutes late, but I'm really excited about today and the topic that I want to share with you. And I usually start my podcast by something that kind of happens previously in the week, and then I kind of share with you some of the lessons and some of the ideas and whatnot. So last week, I was coaching a client, and he asked me after our initial call to send him some of the spreadsheets that I use to analyze the commercial real estate deals that I do. And I thought about it, and because it was our first call, initially I thought, well, we're jumping ahead a little bit too much, but I can understand why. Like, he's excited, he wants to get into it, and I thought, okay, well, what could I do to really, if I just send him some of these spreadsheets, they could easily be overwhelming. And I don't know that if he's really going to get the benefit out of looking at these spreadsheets. And so I thought, you know what, I'm going to give him, and I'm going to create this training that it's kind of like, I don't know if it's a secret, but you won't hear many guys talk about it. And it's what I call the BOE or BON, which is the back of an envelope or back of the napkin underwriting. And underwriting is really just like the financial analysis. So you're looking at a property, and then you start to break down the numbers, and you start to evaluate whether or not it's something that you would consider investing in. And I guess. Okay, so I'm going to jump ahead now. So really, the back of the napkin, the concept behind it is to speed up and look at a deal like really quickly and determine whether or not it's something that you want to invest more time in. And then if you go down that path, you may do like a full underwriting. You may plug in all the numbers into a spreadsheet, or you may just decide to pass on it. And I would say that 95% of the time, just by doing a back of the napkin or a BOE or BON, I'm able to look at a deal and in less than 5 minutes decide whether or not I want to pursue it. Just yesterday I looked at, and a development is obviously more complex, like on the spectrum, if you will. Over here on the far right, you would have, say, the highest risk, which would be like unzoned land. That you would have to go in and rezone, and when I say rezone, let's say it's farmland and you take it to residential, commercial, whatever it happens to be. And then on the far left, you've got maybe single family houses or condos that you rent out in terms of risk, right? And so when you're doing a development, you are like one step away from kind of rezoning land, just because there's a lot more variables. And the reason I tell you that is that I was still able to do a back of the napkin. It took me about 10 minutes because there was a lot more variables and assumptions I had to make. But in 10 minutes, I was able to determine how much I'm going to offer on the land. Does the land work? Does this site work? And we'll see. Obviously, right now it's a little too early to tell what will happen, but I like the site and I think it'll make sense. So, I will report on it if we get it under contract and I close on it. So I think I've already touched on it, but the key to why you would use a back of the napkin is because your time is precious, and if you invest too much energy into deals that don't go anywhere, what happens is you burn out, and that's where I think a lot of guys get frustrated. I've seen, I don't know, call them kind of real estate gurus, and they talk about kind of underwriting like 100 or 200 properties. And while I think that the exercise of looking at all these properties is important, doing like a full financial analysis on each property, I think is overkill. Personally, I think you can underwrite a deal or do a back of the napkin in about 5 minutes, and you're going to get the essence out of it. Now, what I need to do now is tell you kind of how to do the back of the napkin, because understanding how to do the back of the napkin is probably, it takes more than 5 minutes to fully understand. I mean, I was just looking to see if I had the book handy, but I'm reading 3 books right now. one of which goes into this in real depth, and I think it's called The Real Estate Game. It's 300 pages long, and he's a Harvard professor and super smart guy. And so I take all these kind of various resources and books, and I try to assemble them so that I get like the essence out of underwriting, back of the napkin deal, if you will. Another good example would be my 8 non-negotiables. That's a filter or a lens through which I try to look at every property. And I think you can get that just on my website at shanemelanson.com, or that's probably the easiest. Okay, so getting into the actual kind of nuts and bolts, if you will, of the back of the napkin, there's 2 things I want to kind of discuss with you. Number one is there's really a science and an art to investing in commercial real estate. The science is like looking at the numbers today, the rents, the expenses, and coming up with your net operating income, your actual income. And then the second part is the art. And the art is really like the assumptions that you make. And the assumptions are obviously what's going to happen in the future for the most part, because generally you're able to look at the numbers today and determine whether or not it's much easier to look at the numbers today. Let's just put it that way. And the assumptions into the future are really where the skill of investing in commercial real estate comes in. So one of my first experiences trying to raise a lot of capital, and when I say a lot of capital, we were trying to raise $75 million to buy about $225 million of apartments in Texas. And we engaged a PE firm or private equity firm, and their job was to help us raise the equity. And one of the frustrations I had was and I don't know if this is common, but it seems like it is with a lot of the PE firms or investment bank firms, is they spend a tremendous amount of time on the model. And the model is like the financial model, if you will. It was extremely detailed and complex, and it looked amazing. And I suppose that's probably how you get the attention of some of these hedge funds and wealthy families. The challenge I had was a few things. Number one, if we don't actually get the meetings with the right people, then all this modeling is a waste of time. And secondly, the model is only as good as the assumptions. And so it's not to say that there's a right or wrong way. It's just that the way that I would prefer to do it is to have kind of a basic framework and back of the napkin, if you will. Now, obviously, you'd have to clean it up if you're going to send it to someone. However, until you're down the road with an investor or with a property, I think a lot of the busy work, if you will, of plugging into models distracts you from the real essence of, I think I've used the word essence like way too many times in this. I don't even know where I heard it. That's a bit of a side note. Anyways, I just think that it's a bit of a distraction. And I was guilty of it myself, especially when I first started out with my father-in-law. I used to think that I'd have to do like a full package underwriting on every deal that we looked at. And the fact of the matter is, he was able to look at a property, ask about 10 questions, and it was either like, yeah, let's look at this one in more detail, or it's a pass. And it takes time to get to that. And unfortunately, back then I didn't have a framework. It was all in Andy's head. He just knew it It was internalized. So what I do now when I coach and consult with people, or even with my own investments, is I like to have kind of frameworks that I use. Now, I don't actually need to have it in front of me, because obviously if you've been doing it for 10 plus years, I've internalized it now. But when you're starting out, you don't have that. You need, quote unquote, like the framework to be able to refer to, and that helps you quickly underwrite a deal. And I know when I use the word underwrite, when you do the financial analysis, all right? So, okay. I want to give you, okay, so there's really 3 key strategies to doing a back of the napkin. And to go like deep into each of the three would be, like I said, there's like entire books written on it. To truly do it, I do like a 90-minute workshop with my clients so that they understand it, and then they go away, they practice it, then they come back and we discuss it. So obviously, I don't want this show to be like 2 hours long. I think that would bore most people. And so what I'm going to do is I'm going to try to give you kind of the condensed version. So there's three strategies or three considerations. Number one is making sure that you understand the language and the terminology of the back of the napkin. Number two are simple fundamental calculations and numbers so that you understand what you're trying to achieve. And then number three are your assumptions. And what I mean by your assumptions is, I think you know what I mean by the assumptions. I'll get into the specific assumptions in a second. On language, I'm just going to give you a few kind of acronyms, and then I'll define it briefly, because what I think I'll do is probably in the show notes, I will actually do a better job of describing each one of these. But there's really kind of what do I have? I have 5 key terms that are used for doing the calculations. Okay, so number one is your NOI. You've probably heard me say that a lot. NOI is such an important number. It's really the net operating income, and really think of the net operating income as all your revenue minus your expenses and what you're left with. Now, I could complicate it and talk about vacancy and structural allowance and all these other kind of terms, but I want to keep it very, I almost use that word again. I want to keep it really simple in the sense that you just want to focus on what is your net operating income, revenue minus your expenses. Obviously, you can put in a vacancy factor if there's a space that is vacant. The cap rate. Think of the cap rate as if you're buying $1 million building and the net operating income is $100,000. Your cap rate is 10%. So it's really just your the NOI divided by the purchase price. Okay, and that in that case it would be 10%. The other way to think about it is, what is the all cash? If you paid all cash for the property, what's the return you're going to get on it? That's your cap rate. Next one is your CFD, and what I mean by your CFD is your cash flow after debt. So you're going to have your financial cost, your FC, and your financial cost is really the mortgage, and generally that's going to be your principal and interest. Okay, and you're going to subtract that from the NOI, the net operating income. So your net operating income, say it's $100,000. Say your financial cost, your mortgage is going to be, just say $80,000. Your CFD, or your cash flow after debt, is going to be $20,000. It's always kind of dangerous doing math when you're doing live presentations, especially when it's not written out, because that's what I've got for my notes. And then last is your return on equity. And in this case, you could do a return on equity would be your equity is how much money you're putting into the deal. So if you have a mortgage, your equity is going to be a little bit lower, and what that would be called is your leveraged return. And if you're buying all cash, obviously your return on equity is, generally it would just be your cap rate essentially. Okay, so we talked about the basic terms. As it relates to the numbers and what I'll call your basic math skills, I've done several trainings on this in the past, both on video and the podcast. I don't want to get into that right now because I find that it would take too long. And because I've already done it, I think what I'll do is I'll just refer to some of the previous episodes so that you can refer to it. And what it is just basic math skills. I mean, it's like multiplication, division. Like we're not doing like I did horrible in calculus, so none of this is overly complicated. But I will say that the better you have in terms of just kind of doing kind of quick arithmetic in your head, the easier it will be when you're having conversations with agents or sellers. Okay. Now, what I really wanted to focus on today was assumptions, and the assumptions. You will develop better assumptions as you develop more experience and as you understand your market. And so the assumptions that I make on a market that I truly understand are going to be a lot better than if I was to make an assumption on, say, investing in Mexico or, some city that I've never visited, because really what my assumptions are what is going to happen in the future. And it's very hard for me to predict what's going to happen in the future if I don't really understand what's going on in that market today. So, I don't want to seem like I'm pitching my consulting, but in the second week, if you will, of training with people, I go really deep into understanding their market and developing their investing criteria. And what that means is that they have a true understanding of like vacancies, rental rates, supply and demand, all the factors that go into influencing a property's value. And what that does is that allows you to kind of plug in to your assumptions as you go forward. So I didn't appreciate how important the assumptions were until I had a conversation with Jay, who's a friend of mine. And he listened to a previous episode and said, like that conversation you talked about as it relates to assumptions, I really liked it. And I think that you should maybe go a little deeper into that. And so I said, okay, that makes sense. So what I did is I'll lay out, the number of assumptions that I make on any given deal is probably substantially longer. However, I thought I would give you kind of like 3 or 4 kind of really important ones. The first one is, what are the market rents? And so as commercial real estate is really based off of income and how much income is coming off that, understanding the rents, how much tenants are paying, the vacancy, how much demand is on that property, your expenses. Number 3 is the supply of new construction or new developments, because that's going to impact the demand for your property. And last is replacement value. And replacement value is important because if you're buying a building at $100 a square foot, that's how a lot of commercial properties are valued. Or let's say you're buying it at $100,000 per door if you're buying an apartment building. Once again, those are kind of terminologies that people use quite frequently. Then, and that to build a new, say, office building or to build a new apartment building is going to be $200 a square foot or $200,000 per door. Then you have a huge buffer because you can afford to have your rents much lower and still make a satisfactory return versus the new developer that's going to go out and build at double the cost. So that's just it's one of my 8 non-negotiables is buying below replacement value if you're buying an existing building. So understanding replacement value, understanding supply, understanding vacancy, market rents, and expenses. Those assumptions are extremely important as it relates to creating your back of the napkin. Okay. If I was to really boil it down, the science is understanding the income today, and then the art is understanding the income or the NOI into the future. And the variables, obviously, that are going to impact that are supply, meaning how many buildings similar to mine in a similar location are competing for the same tenants, and then demand. How many people are coming into that? If you're in a market that's growing, then you've got more people coming in and more demand. If you have people leaving, then obviously that's going to impact the demand as well. So really, the supply and demand, then you start looking at some of the threats meaning maybe new development coming in, or opportunities where possibly the building is tired and needs some work, and you could improve the look of it and increase the rents. You could increase occupancy. Occupancy is the number of people in your building. So those are some of the assumptions and some of the ways that I look at it. I'm at 19 minutes. I think I will cover this really quickly because I think it's important. I was having a conversation with a gentleman maybe a week ago, maybe 10 days ago, and we were talking about one of his philosophies was, and he actually heard it from someone else, and the idea was he liked to buy single tenant buildings. And so a single tenant building is I mean, probably the easiest way is like a McDonald's could be a single tenant building if it's a freestanding building. But this gentleman, he was talking about industrial buildings. So we're talking like a 50,000 or 100,000 square foot building with one tenant. And he had his various reasons for his assumptions, right, in terms of why that was a good investment. And I take a different approach, right? I look at it much differently, because with a 100,000 square foot building and one tenant, you're really most of your assumptions are based on the fact that tenant is going to continue to stay there. They're going to continue paying rent. They're not going to try to grind meaning like try to negotiate with you when you come up for renewal on that lease, because let's face it, and this, I mean, it may seem like I'm going off on a tangent, but you start to see how they all kind of intertwine. And so if you are a pension fund and you've got, call it 10 million square feet of buildings, and you've got 100 buildings with single tenants, if one of those tenants moves out, it's not the end of the world. You still have 99 that are full, for example. But if you are an individual like myself, and I've got one building with one tenant, and that tenant leaves, and it takes me 12 months or 18 months to lease it up again, then do I have the staying power? Do I have enough cash flow to be able to hold on to that building while it's vacant? And in many cases, a lot of, call it private individuals or private investors, like not publicly traded companies or REITs or hedge funds that have billions of dollars backing them, it's very difficult to hold on to a single tenant property with that much with that much kind of expenses coming out of your pocket on a monthly, or could even be up to a year. I mean, if you take it to the other extreme, which is say single family houses, which is why I've kind of gotten away from it back in 04 to 2008, 9, 10 even, here in Calgary, having single family homes for rentals wasn't a bad idea, because quite frankly, there was just so much demand and you didn't really have to worry too much about vacancy. I think if you were to ask a lot of investors that own single family homes today, the demand has gone down, which means the rents have gone down, which means vacancies have gone up. If you've got a single family house and it's binary, it's either full or it's empty. And when it's empty, if you go say 2 months, in most cases in Calgary or a lot of markets, 2 months vacant is going to wipe out all your cash flow. So it's one of the reasons why I like to have kind of multi-bay, either retail, industrial, apartments. Obviously, I mean, generally most apartments are going to have 20, 30, 50, 100 units. So if someone moves out, it doesn't crush your cash flow. And so I know that that's a bit of a divergence, but it really does wrap into your assumptions and how you look at investing in commercial real estate. So, yes, I guess the last thing I did want to talk about, and we touched on it briefly, and that is, based on your assumptions, based on the terminology, based on the numbers, you're able to then filter it through your decision-making lens. And it's really going to be based on your individual situation. And so the gentleman that likes to do single tenant industrial buildings, that fits his situation. For me, it doesn't. And so your situation is going to be based on how much time you have, how much money you have, what's your risk tolerance, what's your skill set. Do you understand the property? Can you add value? Can you keep it full? All those things are going to influence how you make that decision. Okay, so we're coming up on at the end here. I just want to do a quick recap, and then I'll pass you off to any resources that might be helpful for you. So first is the big idea, if you will, is really using a back of the napkin or back of the envelope to save time and analyze lots of deals, because as I've mentioned, you might look at 50 or 100 deals before you find one good one. And if you try to do a full financial analysis on every one, you're probably going to miss great opportunities or get burned out and just kind of give up on investing in commercial real estate. So I don't want that to happen, which is why back of the napkin. Number 2, understanding the language of commercial real estate. I think it's just really important to understand some of those key terms that I used: NOI, cap rate. My mind's blanking on some of the other ones, but cash flow after mortgage. And so once you understand those, then you can start to plug in and do the calculations, which is number 3, the numbers. And then finally are your assumptions. And so really the assumptions your assumptions will improve over time as you understand your market and you start to look at more and more properties. You're going to start to understand what's the replacement cost, what are the rents, what are the expenses, what are the vacancies. And then with all that knowledge, you're going to be able to kind of, like I call it, triangulate, right? You're taking information from various sources and you're able to compile it and say, based on what I know, I think that there's a real opportunity here. And the title, which is the investing advantage, is really figuring out how to get that unfair advantage so that you can capitalize and spot an opportunity or a gap in the marketplace that you can take advantage of. And that really comes from understanding and having better assumptions than other people. So that is really what I wanted to touch on today. As usual, if you have any questions or comments, please email me. I've started to actually get more and more emails, and some of the emails are great with questions, and I will do my best to answer those. Some of the questions require like a lot more detailed explanation, so I'll do my best. But I think one of the best resources is just to get my book at clubsyndication.com, and there's some other resources as well. That you can get the 8 non-negotiables, some of the checklists that I have. And hey, Robert, good to see you, man. Yeah, I'm starting to lose my voice, so I am going to sign off today. Once again, any questions, please let me know. I always enjoy hearing from you. And if you want to get a copy of my book, I think you can just get a free copy, a PDF at clubsyndication.com. If you want a physical copy, you can email me and I can organize that as well. So that's it for today. Bye for now, and we'll see you next week.